Greetings, my beloved clients and friends. Hey, I wanted to talk to you about why is the stock market so volatile? Because it's been a little volatile lately, and so I want to talk about what causes that. So, Benjamin Graham said that in the short run, the stock market is a weighing system, and in the short run, the stock market is a voting system, and in the long run, it's a weighing system. So what he means by that is that in the short run, the participants could move the market with their vote. It's almost like a popularity contest. And when a popular stock could go up, and when it becomes unpopular, it could go down, because in the short run, it's a voting mechanism. But in the long run, it's a weighing mechanism, meaning that over time, the market will evaluate the true weight or the true value of that company. So that's one reason why it's volatile. And when we talk about volatility, the purpose of this is to understand volatility, where it comes from, not be scared of it, and even to make volatility your friend. So how can we make volatility our friend? Well, let's say we identify a company that has good weight. It's heavy, right? But it's unpopular, right? So that means in the long run, it's going to do well, but in the short term, it's cheap, right? So we could use that volatility to our advantage. Okay, so the stock market is also a price discovery mechanism. So it's trying to discover the price of this asset in this company, and especially when there are divided opinions, and especially when there's passion on both sides of the argument, you'll get a lot of volatility. Think, for example, Tesla last year, right? There were strong opinions on both sides. I mean, passionate, red-cheeked arguments from both sides. Some saying, oh yeah, I would never drive a car that didn't make any noise, or how am I ever gonna do a cross-country trip in that thing? Where am I gonna charge it? Or it takes too long to charge, or it's basically a coal-burning car anyway. Or there was just a laundry list of arguments that the detractors threw out with passion. And on the other side, there were people that were super passionate in favor of it. You'd think if they took off their shirt, they'd have a big old Tesla tattoo on their chest, the way they talk about it. And oh yeah, it's the future, electricity, and it saves the environment, and Elon Musk, and it's going to have full self-driving, and you'd be amazed at what the technology in this, and blah blah blah. And so when there's that type of passion on both sides, it creates a very volatile stock. But if you could kind of look through that and see the winner and see the weight, when there is that unpopularity, you could pick up some good ones. It's kind of like when a fight breaks out on the playground, what happens? It draws a crowd, right? So volatility tends to draw a crowd, and there's excitement and drama and yelling and people making side bets on who's going to win and who's going to lose. Well, if you could figure it out, you could do really well. And I mean, that's an exact picture of, I don't know if you ever seen Wall Street or been there. That's what it looks like. It looks like a fight broke out on the playground. And so that creates volatility, but it also creates opportunity. So think of some of the big fights on the playground in the last year. Tesla was one, and we got in front of that, and when it was unpopular, we saw the weight and we bought it and did well. And the other big fight on the playground in January was a company called GameStop. And same thing. Before it got popular, we saw the wait, and and sure enough, a fight broke out, and our guy won. And so that worked out really well for our investors. And so we're not afraid of volatility. We expect it, and in certain ways it kind of signals us to, hey, something exciting might be happening here. And if we analyze the two participants, or the two sides of the argument, and we see which one makes more sense, we could do pretty well. And the third one that we're kind of in the middle of right now, that it was kind of be growing an argument, and we kind of got in early in on, and I think our guy's going to win this fight, and that's Bitcoin, right? And there's passionate voices on both sides, and it's creating volatility, but in the long run, I think our guy's going to win, and that's going to do well for the portfolio. So like I said, we're not afraid of volatility, and we expect it. There's another thing that I want to talk to you about called the S curve, and it's something that this great book is called Crossing the Chasm. It describes this S curve, and when a new product comes out, oftentimes the first buyers are these visionaries who see the potential in this product, right? And there's very few of them, but they're super excited about it, and they see the future. And it's not enough to make that company overwhelmingly successful, because there's just very few visionaries. And then the next group that kind of jumps on is the early adopters, and they like new things, and they like being, the first one on the block with this new thing. And kind of in your mind, think Tesla or Bitcoin, but there's not enough of them either to make a huge market. And then the company hits a spike in the curve. Think of like a hockey stick, right? As it transitions from these visionaries and these early adopters to the mainstream market, okay? And there's an early stage of that mass adoption. Then there's a middle stage, and then that late stage mass adoption. And when the company goes through that big change, there's big opportunity. So you could call that point. There's another book by Malcolm Gladwell called The Tipping Point that describes that point when it goes from those early adopters and heads into mass adoption. And there's a steep run up, and then it levels off after it gets to mass adoption, and you get normal returns again. So there's kind of risky returns in the beginning, but then this steep climb up, and then it levels off. And think of a company like Amazon or Apple or Nike, right? They've kind of gained that mainstream acceptance, and they're on that other part of the curve where it levels off again, right? But we like to buy the ones at the beginning. It's called the knee of the curve, when it's just crossing from that early adopter to the early stage mass market. And there's a lot in the book, it talks about the risks in crossing the chasm and what's required to successfully cross that chasm. So we look for those signs, and looking back, you'll see it looks like a straight line up, but during that period, there is a lot of volatility. There's a lot of high returns, but there's a lot of volatility. Why? Because they're taking out an incumbent. Think of Tesla, right? For them to gain mass adoption, they really need to take some market share from the incumbents. Think GM and Ford, and they're not going to lay down, right? They're going to fight back. And they're also a threat to a big incumbent like big oil. Think Chevron, Exxon, Saudi Aramco. They're not excited about this electric vehicle. So there's obviously going to be some pushback and some challenges along the way. And that's going to translate into market volatility. But if we could see in the end, man, this company, with all the challenges, they're on their way to winning. I mean, we could do really well. So we expect those companies with the high growth, high returns that are crossing the chasm to get really great returns over that period. But we expect a lot of volatility during that period. And so last year, I mean, our Tesla stock was up, I think, 6x. But included in that 6x, there were 4 pullbacks of 25% or more. And that's just the nature of the beast. Same thing with Bitcoin. You know, think about the incumbents that Bitcoin is going up against. Government and banking. Are there any bigger incumbents than that? So of course there's going to be some volatility. But there's also opportunity for really big gains. So we don't want to have all our portfolio in those type of things, because you guys would probably throw up. I remember my wife, I enjoy paragliding. I have a friend that's really good. He's actually famous. I think he has the record for most loops in a hang glider. He's a friend of mine, and my wife wanted to try paragliding. I said, hey Mitch, would you take Kathy up? And he doesn't do that a lot, do tandem flights, so he's not maybe used to that, but he's good at it, and he's, you know, a great pilot. So I was comfortable with entrusting my wife with him in the air. But so he took her up, and he said, okay, there's a thermal, we're going to start circling and rising in this. And he was, I mean, he has bird equilibrium, so it was a very calm flight for him. But for Kathy, it was quite a wild ride. And she was throwing up, and as they're circling, so she was throwing up on him, and she ended up having a wonderful time, but she did throw up. So I say that because we can't have all, you know, the S-curve type of companies in the portfolio. It'd just be too volatile. So we throw in some companies that have already passed the S-curve and are more stable, like your Disneys, your Starbucks, your Costco's, to temper down the volatility. But that being said, we do like when we see those opportunities of a company that is in that steep part of the S-curve. We do like to throw them into the portfolio to juice our returns, but it will also juice our volatility. So, like I said, we're not afraid of volatility. We understand it, and we actually use it to profit from it. So hopefully that helps. And because we had some volatility in May, you'll see it on your statement. And I just want to prepare you for it. Okay, so have a great day. We're off to the top of the mountain.